That's an interesting way of looking at it, Guy. Certainly the European numbers, both Eurozone and UK, turning down in recent months. Some signs of maybe it bottoming out in the Eurozone, but forward-looking indicators like order books, they're still turning down really quite sharply. So more pain to come. So the upshot is you're looking at signals of Q3 GDP declines, both for the UK and the Eurozone, with that weakness persisting into the fourth quarter. US, on the other hand, is fairly stable at a pretty miserable level, mind you. We're pretty much stalled. So we had a good growth spurt up to July, really, which seems to be fading now. So you might get a good GDP reading for Q3 in the US, but I think Q4 is going to look quite different. So there's just a delaying the pain, really.
That was some cool focusing that just happened on your camera. Chris, delayed pain, does that mean that we're going to see U.S. PMIs roll over to the extent that we've seen in Europe and the U.K., or will the U.S. always, in some ways, outperform?
I think the U.S. will outperform. We've had, obviously, big drags in Germany from the energy price hike. We're seeing that in manufacturing. One of the reasons why the German manufacturing numbers are just so weak. There's been a structural hit, if you like, to the German factory sector, which it's still reeling from. And the US, in contrast, is investing a lot of money in expanding new production facilities with the new acts that Biden's brought in. So I think the prospects for manufacturing in the US are looking a lot brighter than in Europe at the moment. That's a big factor to help. The other side of the whole economy, of course, is the services side, where we're seeing this synchronized weakening of growth from consumers being hit by the increased cost of living and higher interest rates in the US and Europe. That's really beginning to take a toll now. So it's going to be a key thing to watch as we go forward, just how much households are being hit by that element of that headwind.
Chris, the Bank of England apparently saw your data before it made its decision relating to pausing its rate hiking cycle. What within that data do you think would have caused them to pause?
Well, for a start, the weakness of the activity levels, then that's also translating into a sudden, quite worrying downturn in hiring. The job market, as we all know, has been fairly resilient, and that's helped keep this wage growth up. But one of the things central banks are looking for is the labour markets to start weakening and to start reducing that wage bargaining power. And that's exactly what you had in September with those PMI numbers. That's coming through really quite clearly now. But then the other side of it was a sharp reduction in price pressures as well. So although we had higher prices for energy, notably from the oil price hike, that doesn't seem to have cut through. There's other forces at play here, and this reduction in pricing power firms have got. So their costs may be rising, but they just can't pass it on.
And this also goes to maybe the employment part as well, because what I thought was interesting was in the U.S., you're still seeing employment growth, not quickening, versus in the U.K., for example, or Europe, where it's not. Walk me through the why there.
Yeah, well, this is about labour market supply, first and foremost. So, yeah, job growth actually picked up in the US. Now, you've got more people starting to struggle with the cost of living and interest rates, and they're coming back into the labour market, which means some of these long-standing vacancies can be filled now. So this is helping support those numbers in the US. The question, of course, is how long will this persist for? Even in the US, we've got backlogs of work falling sharply now. Companies are going to start looking at their workforce numbers soon if that persists.
Chris, what is the message on inflation?
The inflation, it's stickiness, stubbornness, around the 3% mark. It's not faltering yet. Again, let's watch those labour market numbers. That could help bring it down. Against that, you've got the oil price rise. The overall picture is sort of stuck at 3%. This last leg down to 2% is still looking really unattainable.